Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, it is my pleasure to present why we recently sold Walmart in all of our accounts. As usual, I like to start these videos with a kind of simple overview of how FastGraph works, and in the case of Walmart here, I'm going to look at some various metrics alone without any of the other fundamental attributes added to the graph. So what you have here is adjusted operating earnings, and this is the operating earnings growth of Walmart since 1999. And this actually works out to be January 31st, 1998, keeping in mind that Walmart has a fiscal year end of January. And what you see here is nice earnings growth. Earnings grew very nicely up through we get in here to the 2013 era. And I also want you to notice that Walmart performed very admirably during the Great Recession as a business. Now, as we entered 2013, we first started to see a flattening of earnings. And then more recently, we've seen a couple of years of down earnings. That was respectively minus 1% in fiscal 15, minus 9% in fiscal 16, and minus 6% in fiscal 17. So that's, from a point of view of looking at what's going on with the company, you can see that things have changed here in recent years. Now, I'm also going to add dividends, which also represents the company's dividend payout ratio here, which will look as a white line on the graph. And you can also see here very quickly that Walmart had really great dividend growth up through 2014, but I do want you to notice that that rate of change of dividend growth has flattened, consistent with some of the issues the company has been having. Nevertheless, the company still is offering, from an earnings perspective, a dividend payout ratio that was very low in the beginning of this presentation, and it has gradually increased up to the 46% range. Now, by the way, that's not uncommon, because as a company gets as big as Walmart with over $270 billion in market cap, growth obviously would be expected to slow down, and that would also include the dividend. So they continue to maintain a dividend growth policy here. But I think what's really important about this, if you look at it over those years that I just highlighted, the dividend growth has been relatively meager compared to historical norms. You can see that when they were performing very well from an earnings point of view, they were raising their dividend quite nicely. The average is still high, but obviously if I shorten this graph, let's say to a 9-year graph, which covers this area, you'll see that dividend growth, has averaged only about 6.5%. And then, of course, if I cut a couple more years off that and just look at dividend growth during this time frame, it's averaging about 2%. So things are changing at Walmart, but they're perhaps not as bad as some people would like to lead us to believe. Now, next, I'm just going to go through several other metrics here. This is adjusted operating earnings. I'm also going to look at GAAP earnings because I think that's important. So when you're looking at GAAP or diluted earnings, you can see that the stress has even been greater here, which indicates there's certainly some, depreciation expenses and other maybe recurring and sometimes even non-recurring expenses included there. But nevertheless, their GAAP earnings are still adequately covering their dividends. Next, let's look at operating cash flow. What I'm really looking for when I examine operating cash flow again is the company generating ample enough cash to go ahead and cover their dividend. And you can see from an operating cash flow payout ratio, Walmart's operating cash flow payout ratio is increasing like we saw with the earnings payout ratio, but they're still only paying out somewhere in the 20 to 25% of their operating cash flow to shareholders in the form of dividends. So the dividend appears well covered based on cash. Next, I've gone to free cash flow, and you'll notice that Walmart has enough free cash flow to basically cover their dividend historically. A couple of years it was, pretty high payout ratio, but the real point is this is money left over after what they needed to run their business. So the company is still generating a very healthy level of free cash flows and dividend coverage based on those free cash flows. Next, I'm going to look at EBITDA, and a couple of things, of course, immediately come to mind as we've seen in the previous slides here. You have a slowing down of EBITDA growth here. In other words, if I drop this to, let's say, that 9-year graph again, EBITDA growth drops to 7%. Where on the long-term historical graph, it's averaging almost 10%. And of course, that's because we had high growth here, and now this growth has really flattening. But once again, a lot of EBITDA to cover, any obligations they have relative to dividends. And then finally, I'm going to take a look at EBIT, which is simply EBITDA without the depreciation and amortization. And let's look at what Walmart looks like on that basis. Now, relative to what we saw with EBITDA, you'll see that EBIT, there's actually a more stress here in these recent years, which would tell me that there is a lot of depreciation and perhaps amortization expenses baked into the EBIT numbers relative to the EBITDA numbers, which excluded the depreciation and amortization. Now, I've moved back to adjusted operating earnings here because I want to focus a little bit on the fast facts relative to earnings, because earnings are what you see most often talked about or reported in the financial press. So just a couple of fast facts. On February 27th, the company closed closed at 91.52 with a blended PE ratio of 20.4 and a 2.3% dividend yield. You can see their growth rates have been pretty attractive even in spite of this dip, averaging almost 9%. But of course, it's been slower, as I pointed out more recently. It has a market cap of $271 billion. It has a AA credit rating and only 28% debt to capital. An interesting feature that you might not be aware of, Walmart has also split their stock a lot, but the last split they had was actually in 1999. So if I just click it here, so it's been a long time since they split their stock, which has been relatively common for a lot of companies recently. But previously, when they were a real fast growth company, as you can see by this little panel here, they did engage in a pretty significant amount of routine stock splits over time. And all that does is adjust the price, not the value. Now, at this juncture, I'd like to move into some valuation references here and talk about really the primary reason I sold Walmart was valuation, not their fiscal 2018 financial report. So what I've got on here is I've got a normal PE ratio calculation, which is this dark blue line, which represents a PE of 21. And then I have the theoretical fair value calculation as another valuation of the PE of 15. So simply, you've got a PE of 21, almost 22, and a PE of 15. And this just gives you a valuation range. So now let's bring stock price into the equation because that's where this whole discussion gets really interesting. So I'm going to overlay monthly closing stock prices on the graph. Now, I want you to notice something here. It's very important. This is a very high normal PE ratio calculation that is mathematically correct, but it's not really representative of what I would consider Walmart's normal PE ratio because PE ratios for Walmart got very high, back in 1999, 2000, etc. And then they got very low coming into the Great Recession and coming out of the Great Recession. You see these very low PE ratios. And this is the one that really befuddles me a little bit. When you look at what was going on in earnings for fiscal years 15, 16, and 17, you see this negative growth, which the market reacted dramatically, but something stimulated the market to change their view in late 2016. But as I mentioned in the written part for 2017, Walmart for that year roughly, and I've got it pretty close or maybe a little long, Walmart had a tremendous run. It actually increased over 59% in just that almost, maybe 13-month time frame. As I mentioned in the article, this was significant momentum. So what I really want to do before I go on though is I want to shorten this graph to 15. I want to get rid of these anomalous valuations. But before I do, I want you to notice something here. This was a period of time where Walmart was growing beautifully, and the stock price actually, if you go into 2000, and I'll go in the middle here, so or maybe a little earlier, I'm not trying to hit the perfect top, you can see that Walmart represented dead money, actually a negative rate of return. You would have lost a quarter of your capital holding it for these 5-year period of time, averaging a 2.5% annualized negative rate of return, but the company was growing quite nicely. You can see the earnings growth rates down here. The business was performing beautifully. So why the poor performance? To me, it's as obvious as night and day. The stock was ridiculously overvalued here, and even though the company performed well, the stock had nowhere to go except steadily moving or reverting to the mean, as some people like to talk about. But let me get rid of some of this anomalous stuff here, these really high valuations. Let's drop this to a 15-year graph and watch what happens to the blue line. The blue line and the orange line both end up almost superimposing on itself. So it becomes very clear from this iteration that a 15 PE ratio, at least from a historical basis, has been a very prudent or rational valuation level for Walmart shares. So currently at 20 times earnings, even after this, roughly 12 to 15% drop here we saw in the last week or so, Walmart still remains significantly overvalued. If it moved back to a 15 PE based on these earnings estimates, you would actually have a negative rate of return holding Walmart for the next 2.5, almost 3 years, which by the way is a hint into why we decided to go ahead and get out of our position. And I'll talk more about that in a minute. Nevertheless, at this point, let me just suffice it to say that I like Walmart at a 15 more or less PE ratio most of the time, and I never really like it when the PE ratio gets above 15. You can see a 17 PE and a 17 PE on 2008 actually led to, again, some pretty poor performance for, to me, an untenable long period of time, 3.5, 4 years. And I think that's where we are right now. So this had been sitting on our watch list, and as I mentioned in the article, I knew the earnings report was coming out, in January, it's their fiscal year end. So I knew we were going to see some information in possibly February or March. But the point is, I waited because the stock had momentum. And if there was good news, I could have squeezed out maybe some additional return. But in this case, The market killed the stock on the day their financials came out. But nevertheless, as I'll show you in a minute, I didn't get the perfect top, but I still got a high valuation for my shares. So one of the advantages I have of fast graphs is I can keep track of my purchases and sales. So we originally purchased Walmart on September 15, 2013. And I'm just iterating 100 shares here, just as an example, if you will. But we bought it at $74.70. The PE ratio at that time was 14.7, or slightly below our 15 PE kind of ideal valuation. Now, as I talked about earlier, you can see that Walmart actually performed real well for the next year. In fact, if I'd have went ahead and sold it, if I had that kind of foresight or insight, which I don't, we'd have averaged 15.6% annualized. But then, of course, as the earnings began to weaken, as you can see here, the stock price reacted, in my view, appropriately. And to be honest about it, I had all of a sudden become very concerned about my position. I also want you to notice that the dividend growth rate had begun to slow down significantly during this period of time. You can actually see the white line flattening. So we waited to the earnings report, had a horrible reaction from the market, enough to drop the stock 15%, and we were looking at $92.95 for our sale. So if I calculate what performance was during my holding period, a $10,000 investment in Walmart on August 15, 2013, and held until February 22, 2018, generated a 7.1% rate of return. Now, I'm not bragging about that. That's not great, but I'll take 7% over a loss, let's put it that way. But the real reality of it here, I bought this stock to hold it permanently. That's always my position when I'm buying a stock. And I had a positive rate of return, but I was also faced with what I consider to be some irrational overvaluation here. So we waited for the earnings report. We got a 15% discount on our valuation at that point, but nevertheless, we still felt the valuation was high enough at that level to go ahead and sell it. We made 7.1%. We got almost $1,200 in dividends. We got about $2,400 in profit. It's a total rate of return of 36.4%, annualized at 7.1. And the reason we sold it, of course, was because at this juncture, with everything that's going on in the marketplace and with Amazon and all the negative news out there, I feel like Walmart would be dead money for the next 2 or 3 years, and I do have other options that I'm looking at to replace Walmart with. So next, I'd like to move to fund graphs, financial underlying numbers, and I'm going to start by looking at the in millions graph and look at some things that I talked about in the written portion. For example, we talked about revenues. Now, this is quarterly data here. These are about 12 quarters, obviously, of historical data. And as Walmart reported, or as it was reported by Standard & Poor's Capital IQ in the situation report, they reported, over $135 million versus for the fiscal year 2018 versus only about 130 plus million a year ago. So I considered that a positive. So now I want to briefly go into the per share graph and look at some per share data. And what I'm going to first focus on is adjusted earnings per share. Now, there are a couple of interesting things about looking at Walmart from this perspective. As they reported, they earned $1.33 in the final quarter, which ended January 31st, 2018. And that was in comparison to only earning $1.30 in the January 31st, 2017 quarter. So it was an improvement over the same, quarter of the previous year. But here's what I really want to focus on. I want you to notice that it's the first quarter for Walmart, but it's really the Christmas season. This is always one of their strongest quarters, which would be the final quarter of the year, if you will, which ends in January. So you can see these are always the biggest quarters, but I do want you to see that each of these years, or for 2 of these years, there was actually a negative growth in adjusted earnings, and it's a little weaker in more recent years, but that's consistent with what I showed you earlier. Finally, I looked at Walmart's net income per share, which was really one of the red boxes I had around the data. As you can see, their net income per share for 2018 was approximately 73 cents versus $1.22 plus, rounded $1.23 in fiscal 2017. So compared to these other fiscal years here, you see that we have had some quarterly stress, but we saw that on the other graphs. And of course, this is the kind of thing that can really spook the market. But I think the big thing was quarter over quarter, fiscal year 2017 versus, which was $1.23, came out only at 73 cents this year. So that was a big cautionary point. So now I'd like to summarize and kind of close this video just offering some perspectives. This is a 15 PE ratio, the orange line. You can see the effects that overvaluation has had historically on Walmart stock. When valuations got crazy high in 1999, the PE of 55, that led to significant price weakness. In fact, if you want to see how bad it actually was, if you go from kind of peak to trough-ish, it was losing 1% a year, lost 25% of your money roughly over this 8 or 10 year time frame. And this was in spite of the fact that the company was growing earnings quite well, and it was also in spite of the fact that the company's dividend yield or income was growing nicely. But the bottom line is, I think Walmart actually did better than I would have hoped, and I took advantage of it. I've never apologized in my life or never regretted in my life taking a profit on a stock. I think Walmart is still the company it was when I bought it. It's going through some issues here. Part of this is what I'll call a reaction to the threat of Amazon. But remember, there was a lot of depreciation and amortization we saw in the EBIT numbers. But the real key is here, are they on track to start growing again? Well, the analysts think they are. The analysts think they're going to grow at 8 or 9% a year. The analyst scorecard on Walmart has been very attractive relative to the short time frame we have here, but more recently there have been some misses. But the bottom line is, if you look at a longer term growth rate, analysts are expecting the company to go back to a 6 or 7% growth rate. I would consider that possible, but nevertheless, I think this dramatically weakens the future return potential of Walmart in spite of the fact that they might continue to grow their dividends. So there's some optimism here, but even with this optimism, I would argue that Walmart is no longer an attractive investment, and therefore we sold it. This has been Chuck Carnevale saying thanks for listening.